All right, welcome to the webcast, everybody. We're going to be talking about long-term care today. I'm glad you've joined us. We're going to cover a whole lot of information. I'm going to try to do this in about 1 hour. So everybody should be able to see the slides, whether you can see me or not. I don't know. It appears at this time you can't, but that's fine. The slides are much more important than you seeing me talking. And hopefully you're hearing me okay. Some of you I know are on audio only on the telephone, so I'm going to be using the slides, but I'm not going to try to rely so much on the slides that you can't follow at all if you're on telephone only mode. So again, why should you care about long-term care is the topic of our webinar today, and I'm going to try to cover as much information as I can. If you do have follow-up questions, feel free to give us a call. I'd be glad to talk about your individual situation, whether this is something that you're looking at or maybe you even already have some type of protection in place through group or individual coverage and you want to know if you should supplement that. Sometimes that makes sense. So we're going to cover a lot of those things during the webinar today. This is becoming an increasingly hot topic, and I think it's just for really several reasons. It's really a lot of reasons, but I think one of the biggest is we're just living longer and longer, and we're seeing family and friends and relatives and so forth experience the need for long-term care. We're going to kind of talk really about what long-term care is because there's even some confusion in that regard. But when you look at it, baby boomers are increasingly aging, and as of January of 2011, baby boomers actually started turning 65. And so when you look from that point in time for the next 18 years, it's expected that about 10,000 baby boomers will turn age 65 each and every day. And at 65, of course, you are eligible for Medicare, but that is federal health insurance for the aging and disabled. It does not cover most long-term care as we're talking about in today's call, and I'll kind of be talking about some of the differences. And, of course, healthcare costs are rising, really just for the overall general public, but specifically for those that are in retirement and age 60 plus. So when we look at the value, the present value of all the costs that a couple is likely to experience throughout their retirement years, out-of-pocket costs, we're looking at almost an estimated $200,000. That includes insurance premiums, that's out-of-pocket costs, home health care costs, but not long-term care costs. That's everything but long-term care costs. And there's an actual about 1 in 20 or 5% risk of those costs exceeding $311,000. $260,000 is the estimated value of uninsured costs, including long-term care. So when you throw long-term care in the mix, it's over $250,000. What's interesting is sometimes I'll hear people say, yes, but I don't want to protect against that risk because there's a chance I will never need it. But I think if we took that same person, if they had a home worth $197,000 or a home worth $260,000, they would never, ever consider not insuring that home when, in fact, the likelihood of that home burning down or getting swept away by a tornado is statistically so small, and the likelihood of needing long-term care protection sometime during your retirement years is statistically so high that I think if you have assets, it does not make sense to at least consider long-term care protection. And kind of generally speaking, I think for most people, if your assets, your savings and investment assets, your liquid assets are $250,000 or less, you might not need long-term care insurance depending on your circumstances. If you're $250,000 to $500,000, you probably need to start thinking about it. If you're $500,000 or more, you definitely need to consider long-term care insurance. It's too much assets at risk, too much money you would have to spend out of pocket before you qualify for Medicaid, leaving the healthy spouse with Social Security only in many cases. So it's definitely something that I think you need to think of not only as an out-of-pocket cost risk, but an asset protection element that should be built in there as well. So, as I said, long-term care, I think that the interest in looking at this has become more and more driven by people aging. More of us are living longer and longer each and every year. Each decade, the numbers for life expectancy increase quite a bit. And again, we're seeing a lot of friends and family who are already in need of long-term care, and the costs just keep going up. So those are really the three reasons that more and more people are considering long-term care. So today we're going to talk about some of the terminology when it comes to long-term care. We're going to talk about long-term care costs. We're going to talk about the types of long-term care insurance or protection that you can put in place to help protect against those costs. There's traditional coverage and there's hybrid coverage. And they both have advantages and disadvantages, so we're going to talk about that. And then some planning ideas as well. So when it comes to long-term care, I think so many people think of nursing home care. And while that's part of long-term care, most long-term care services are provided outside of a nursing home. That's kind of the last resort. That's kind of the last stop, if you will. You want to be protected when it comes to long-term care so that hopefully if you could get care at home or maybe an adult daycare or assisted living, those are things that would probably come into play before the nursing home. And when long-term care insurance first came out, it was called nursing home insurance, and that is all it did protect against. But now it's typically comprehensive in nature, and most of the claims are home health care claims. About 80% of the claims that are filed are for home health care benefits. Now, it can cover medical needs and non-medical care. The type of care depends on the severity of the health problem. So when we look at long-term care, how do you define what that is? And it's really defined as the assistance or supervision that you might need help with at some point in time in what are known as the ADLs, which is an acronym for Activities of Daily Living. And that would be eating, and then most policies are standard in this regard. Where in the past, one company might have 5, one company might have 6, one might have 7 different triggers, if you will. And with most policies today, it's eating, bathing, dressing, toileting, transferring, and maintaining continence. If you cannot do 2 of those 6, any 2, or with most current policies that are available in the last several years, if you can't remember to do 2 of those, physically you're fine, but you can't remember to eat or do some of these things, then you would qualify under a cognitive impairment provision in the policy, even though physically you can do 2 of those things. And typically that's as stated by a healthcare professional like your physician, and then of course the insurance company usually has somebody either do a phone or a live interview with you. And once you hit those, and then we'll talk about this more in a minute, and then it starts to trigger the potential policy benefits if you do have protection in place. So custodial care is the primary care that is covered when it comes to long-term care protection. And it's the most common long-term care, but it's not covered by Medicare. A lot of people think that Medicare covers these things, when in fact Medicare, I'll use a nursing home as an example, if you follow all the parameters, I think you have to go directly from a hospital to a nursing home. You have to have been in a hospital for, I think it's 10 days or more. Don't hold me to the exact on this, but you have to jump through these hoops, and then you might qualify for up to 100 days of care in a nursing home, and Medicare might cover that. Most long-term care policies have a waiting period. Otherwise, the premiums are costly. If you want that coverage to start immediately, the premiums are kind of high. We usually recommend a 90-day waiting period because that closely coincides with what Medicare might cover. But in either case, many of you could cover those costs for 2 or 3 months. But if you had to pay $100 or $200 per day for 2 or 3 years, it could wipe out a big chunk of your assets that you've worked very hard over the years to accumulate. So you can go longer. You can have a 6-month waiting period or a 1-year waiting period, and your premiums would be less. But 90 days seems to be a good middle ground for most people when we run quotes. But the purpose is to assist you with these activities of daily living. That's the purpose of the care. And it's performed typically by some sort of trained aide in a variety of settings, and again, it's often in the home. The care is generally designed to maintain rather than improve health. So the types of care, I've kind of referenced these already, but it'd be home care, assisted living, adult daycare, and then nursing home care. Those are the different levels of care that would be considered long-term care, and most current policies, if you have long-term care protection in place, will pay for some amount of all of those, and I'll talk a little bit more in a minute how that works. Because some policies, for example, have a daily benefit amount that you're protected. Some have a monthly benefit amount, so it might be $150 per day paid monthly once you qualify, and then once you hit your elimination period, which is kind of like a deductible. Some might have $4,500 a month. They might be expressed in a monthly amount. And then some policies have the same dollar amount for all levels of care. In an individual policy, you can choose. Do you want your home health care benefits to be the same percentage as your nursing home benefits? That's usually what we quote. We typically start with $150 a day, which is the approximate cost. I've seen higher and lower, but in North Texas, the approximate cost, I think of a private room is a little over $150 a day. Semi-private's a little under $150 a day. But home care is typically less than that, unless you're receiving a lot of home care, and then when it gets to that point, usually you end up moving to assisted living or a nursing home. But my point is, you can have a policy that is, say, $150 a day for nursing home care, or 50% of that for home care. I like to do the same daily benefit across the board. That way you keep all your options open and you have the same pool of money available regardless of what level of care you have. But we can slide those back and forth on an individual policy, and it will adjust the premium accordingly. Now, for those of you that have group coverage either already in place to a degree or you have that available to you, which, by the way, is becoming less and less prevalent. A lot of local companies that we're aware of have dropped group long-term care insurance for their employees, not the ones that already have it, but for those that have not already purchased it, they can no longer get it, either whether they're a retiree or an employee. That's becoming pretty prevalent here in the last couple of years. Those are typically 50 or 75% of your daily benefit amount for home care and assisted living, and you can't choose. You can't slide that back or forth. It's just kind of what you see is what you get. I'm not putting those policies down. They are pretty good for group policies. There's some things that aren't as comprehensive as an individual policy, but certainly from a cost standpoint, they're a really good value. And some people like to have that as their base and then add a layer of individual coverage on top of that. And we can talk about that if that describes you. So the risks when it comes to custodial or long-term care, again, it's not covered by Medicare except in rare cases for limited periods of time. So it ends up imposing a significant financial risk. And if you look at, I mentioned statistics earlier, but I didn't share the actual statistics. 70% of those over age 65 will require some sort of long-term care at an average cost of $100,000 a year, an average need of 2 to 3 years. So some people are lucky they never need the care, they never have to spend the money. Then there's the extremes where somebody needs care for a number of years, and then in most cases it's somewhere in between those extremes. But it can be very devastating to your retirement income, to your assets, and to your estate plans if you don't have a plan in place to help protect against these potential costs. So when we look at long-term care costs in a facility, and these are as of a couple of years ago, but they haven't changed too much over the last couple of years. We've actually seen a little less increases lately than we had in prior years. But assisted living facility, this is a one-bedroom, single occupancy. If you slide across the right there, a semi-private room is kind of the first line. And for those of you that are audio only, I'm kind of covering here what it would be for a semi-private room. Kind of the national monthly average is $32.61 a month for a semi-private room. That's $193 a day. We're a little below the national averages in North Texas. Where in the Northeast, it can be 2 to 3 times very easily what it is here. So a private room, the national median rate is $213 a day. Semi-private, $193 a day. But from 2010 to 2011, that was an increase of 5 to 6% between those semi-private and private rooms. Home costs, the national average for home health care aides for licensed aide is about $19 an hour, where adult daycare is about $60 a day. And the increase over 2010, there wasn't one. It was about the same from 2010 to 2011. So paying for long-term care, and this has always been the case, there's 3 options. The government will pay, and that's if you don't have any assets, and then actually if you're married, there's a spousal impoverishment amount that can be maintained by the healthy spouse. You have to spend down to that level. Then the government will pay for the person that's in need of long-term care, and that healthy spouse can maintain. And I think it's a couple $100,000. So that's why I say if you're at $250,000 or below, you might not need long-term care insurance. But if you're at $500,000 and above, you probably do need long-term care insurance, with the exception of those that have at least $2 to $3 million or more, and you don't mind paying out of pocket, and it wouldn't devastate you. Now, we've run into some folks that can afford to self-pay, but they don't want to incur this big cost. They'd rather basically spread the risk and pay the premiums either way, whether they need it or don't, but not have to have a big outlay if they do end up needing it. and we can help you with that decision if that describes you as well. But I heard years ago this was kind of meant in jest, but it really is reality. When it comes to long-term care, you can be rich, in which case you just pay for it out of pocket. You can be poor, in which case the government pays, or you can be in between, and you can either be insured or you can not be insured, and if you pay out of pocket, you might end up poor and Medicaid will pay. So if you, just like anything else, if you have an asset you want to protect, it makes sense to insure it. And that's where most of you fall, is you have enough assets to where it probably makes sense to protect those assets, and long-term care insurance is the best way to protect against these potentially huge costs. So Medicaid provides health care for low-income individuals. It's different from Medicare. The difference is federal versus state. Medicaid is a state program. Medicare is federal. Medicaid can cover long-term care, but again, you have to have spent down or not have assets in the first place. Each state has its own rule for eligibility and services, and again, I think it's around $200,000 in spousal impoverishment amount. Otherwise, if you're single, you pretty much have to spend most of your assets, and then you'd qualify for Medicaid. Oh, and by the way, you can't just give your assets to a family member and then apply for Medicaid. That's considered fraud, and they actually, if they see that you do that, you won't be eligible for Medicaid until you're out of pocket the amount that you gave away. Hopefully you can get it back from whoever you gave those assets to. We don't see that happening as much as we did, say, 20 years ago, because 20 years ago there was not a look-back period, and people would give their assets to their children or what have you and then apply for Medicaid, and the government would pay for their care. And it was being abused to a large degree, and so the government really cracked down on that, and now there's a look-back period, and it's either 3 or 5 years. I know you can set up Medicaid trusts, but those have a 5-year look-back period. So you have to really plan in advance, and you have to trust whoever you're putting that money into that trust on their behalf, because it's an irrevocable gift. You're putting that money in there in hopes that somebody else is going to take care of you, when legally it's now their money. And if you have any need in the next 5 years, it has to come back out, essentially, or you can't qualify for Medicaid to begin with. So we don't see very many people utilizing that strategy, because you basically have to give all your assets away and hope nothing happens for a period of time, and hope that you could trust whoever you gave those assets to in the trust. So insurance just seems to be a much more common way to do it, without having to give your assets away and hope for the best when it comes to the time frame. So long-term care insurance, it's provided by private insurance companies. It's purchased, and it's kind of obvious, just like you can't buy life insurance when you're terminally ill. You can't wait till you have a need to think about long-term care insurance. And unfortunately, that's when I often get a call. I'll talk about long-term care insurance. Sometimes clients will procrastinate. A few years later, I'll get a call from the husband or wife. They'll say, my spouse has just been diagnosed with dementia. What do you think about us getting long-term care insurance now before it gets too bad? Well, once it's in your medical records, once it's been diagnosed, it's probably too late. And it's so much cheaper when you get it younger. You're protecting your insurability, but you're also building in a much lower premium structure when you get it when you're younger. And sometimes people ask me, how young should you be when you think about it? It seems like most people, the ideal time's in your 50s or 60s. I just turned 50, and I'm actually applying for long-term care insurance right now. Might be a little bit early, but I feel like I'm protecting my insurability, and my premiums are going to be lower. Yes, I'm going to pay for a longer period of time, but I'm locking in a lower premium. Not that those premiums are guaranteed, but they don't increase premiums real often. It does happen sometimes. As a matter of fact, some companies have gotten out of the business in the last few years because they've been losing money on these long-term care insurance policies, because people have lived longer than they thought, the claims have been higher than they thought, and they're not in the business to lose money. But in other cases, they've just raised the premium somewhat to help insure against the future increasing costs. Now, a lot of times what they do is they come out with a, quote, new and improved, end quote, policy, and they'll add some bell or whistle to it, and they'll raise premiums for new policyholders. And occasionally they'll do it for existing policyholders, but they can't single you out. It has to be for the whole class of everybody in that policy in that state. So the policies usually include a pre-selected daily coverage amount. Again, earlier I said sometimes it's expressed monthly, sometimes it's expressed daily, which is actually more common of the two. So $150 a day, whatever that works out to a month. I think it's $4,500 a month. And you would get a check monthly, and that's after you qualify, so you are unable to perform 2 of the 6 activities of daily living, or due to a cognitive impairment, you're unable to remember to perform 2 of those activities, then your elimination period has to be satisfied. 90 days is real typical, but you can pay a little higher premium and have it virtually start immediately, or you can lower your premium and have it kick in after, say, 6 months. So once it kicks in, then there's a benefit period. So there's a daily amount, so it'll pay X amount per day up to, and if your benefit amount is $150 a day, it'll pay up to that for 2 years or 3 years or 5 years, or there's even some lifetime policies, which are quite expensive these days. So most people do a 2, 3, 4, or 5-year benefit period. But what that does is it provides a pool of money. So let's say you have $150 a day, and you have a 3-year policy, and you end up needing some care, and maybe it's at home, and you're only using a fraction of that $150 a day. Maybe you're using just an average, let's just say, to keep it simple, of $50 a day. Well, you essentially have a pool of money. So if you needed home care the entire time, and you were only using 1/3 of your benefit, then that 3-year policy essentially becomes the equivalent of a 9-year policy. I hope that makes sense. You're drawing from the pool, and if you don't use it, you don't lose it, it stays in the pool. So if you use the full daily benefit amount, once you qualify and it never drops below that, then it would be, in my example, $150 a day for 3 years, and then it would stop. Now, and I think I have a slide about this later, what we're quoting most often now is called shared care. If you are a married couple, and you actually don't even technically have to be married, but have a significant other that lives in the same home and is expected to do so for a long period of time, then you can apply for shared care. And I really like that because what it does is allows you to get a lower benefit period. Maybe you don't have to get 5 years, or maybe you don't even have to get 3 years. Maybe you get 2 years each. But essentially what it does is if you use up your whole 2 years, then it goes over and borrows from your spouse's policy and uses their 1 or 2 years, depending on the company. They all work a little bit differently as to how much of the spouses you can use. One company, you can actually use all of your spouses, and then if they need care down the road, they actually have a 50% remaining balance of their pool, even though you used their pool. So they all work a little bit differently, and we can help you with that one-on-one. And then another thing that I think is real important is if even though you have a benefit period and a benefit amount, if you're younger, and I'm talking 50s, 60s, and even early 70s, you probably want to have an inflation rider on the policy. What that does is allows the benefit to automatically increase every single year by some stated amount. We usually recommend a 3% compounded increase. So if you started at $150 a day, a little over 20 years down the road, you've got $300 a day. Well, that's important because if you get one of these at 50 and you don't need it till you're 80, it could be 150% of what the costs were when you got the policy. So if you get a flat benefit amount and it never goes up, then over time you're going to be self-insuring for part of it. But as you age and inflation becomes less important, like I set one of these up years ago for a lady that was 84, right before her 85th birthday, which many companies won't consider a new applicant once they're 85 or older. And she was 84, she applied, and she said, Burke, I don't need inflation protection. I mean, I might be around for a little while, but not long enough to suffer from a lot of inflation. And she actually ended up using the policy benefits for home care, and quite sure she got more than her premiums back in a fairly short period of time. I actually looked at an illustration the other day from one of the companies, and in most scenarios, the period of time it took to receive 100% of the premiums back was less than 6 months. In a lot of cases, it was 60 to 90 to 120 days. All the premiums were received back in policy benefits if and when it kicked in. Of course, if it didn't kick in, then you're throwing the money in the pool to benefit the others who do end up needing it. Now, they do have some limits, and they do have some exclusions, which I'll talk about on another slide. But there's not a lot of exclusions, but you'll see there's a few here in a minute. So there's 2 types of policies. There's traditional, which is probably what most of you have heard about, and this is where you have a daily benefit like I talked about, you have a benefit period, you have provisions for home care, assisted living, and maybe it pays the same amount for those levels of care that does nursing home or some percentage of, and you make a monthly or quarterly or annual premium just like you do with homeowners insurance and auto insurance and health insurance. You pay ongoing premiums for that ongoing coverage. But here in the last few years, they've come out with hybrid policies. Most of them are a single premium life insurance policy. You write one check. So I'll use my recent quote that I'm considering in my case. So I'm going to do $100 a day traditional policy, but then I'm going to do a lump sum possibly, and that is going to provide $100 a day. So depending on your age, it could be a one-time payment of $50,000, $75,000, or $100,000, but then you're done. So I'll give you an example of a client that I spoke with here a few weeks back. She's 62. She had $125,000 in a CD that was about to mature. It was going to roll over and pay her a very small interest rate. Instead, I said, why don't you consider this lump sum life insurance / long-term care policy? So a $100,000 one-time payment provides a death benefit of $150,000. So if she puts the $100,000 in, she never uses it during her entire lifetime, her family will at least get the $100,000 back. The initial death benefit was $150,000, but over the years it reduced down to $100,000. So at a minimum, they get the money back, the premiums back at death. If she changes her mind at any time, she can get a 100% refund of the $100,000. Anytime from the day it's issued till the day she passes away, she can get a full refund. Now, if she's used some of it for long-term care benefits, which I haven't come to that part yet, it would be reduced, obviously. But if she has not needed it for anything and she wants a full refund at any time, she can get all of the money back. If she never uses it, dies, at least all of the money, if not more, goes back income tax-free to her beneficiary or beneficiaries. Or, ultimately, the primary goal is if she does need long-term care, it provides an amount that's 3 to 4 times the one-time payment. So that one-time payment of $100,000, in her case, provided, I think it was $360,000 of initial long-term care benefits. Divided over a number of years, it came out to, I think, $150 a day. I forgot the number of years. It was somewhere between 3 and 5 years of benefits. So it kind of works in reverse like the traditional plan. It provides a daily benefit. It does have a daily maximum. It does have a maximum pool of money. It does typically have an inflation rider. And in her case, that 300 and something thousand between age 62 and age 80 grew to, I think it was about $800,000 in benefits by the time she was 80. It was in somewhere in the $600,000 to $800,000 range in total benefits. But what she liked about it is she never has to write another check again. She's not really giving up that much because she wasn't going to make a lot in the CD anyway. Now, she might not make anything here. If she puts in 100, she probably won't. But if she changes her mind in 10 years and wants it back, she doesn't earn any interest. But her comment was, well, if I rolled over the CD every year for the next 10 years, it wasn't going to make a lot of interest likely anyway, even if rates go up. So why not have the protection and then get all the money back if I decide I don't want it anymore or if I pass away and don't use it? So there's pros and cons of each. In some cases, a combination of the two can make sense. But if you're of the category that thinks, this makes sense, but I can't stand the thought of paying premiums and never cashing in and losing those premiums, which, by the way, is how all insurance works. But if that bothers you to the degree and you had the ability to write a one-time payment, then maybe this hybrid makes more sense because you never have to worry about premium increases. You never have to worry about passing away and it not being used. It's going to come back to your family in the form of a death benefit. And if life changes and you want your money back, you can get your money back. So that's something to be considered as well. But again, they both kind of have their pros and cons, but we'd rather have some level of protection if you have assets that need to be protected and you want to protect against these costs. To me, it's not as important which type. It's more important that you have some coverage. Now, traditional long-term care typically has either nursing home or home care or both. Most of them today have both. Most of them have skilled care, intermediate care, custodial care, home care. Pretty much once you trigger those benefits under the 2 out of 6 activities of daily living and you've met that elimination period, which is kind of like a deductible, then the checks would start coming in as long as you need that care. Again, there's benefit triggers. That's the activities of daily living. There's benefit amounts, usually expressed in a daily or a monthly benefit amount. There's elimination periods, which are like a deductible, and then there's a few exclusions, which I'll talk about here in a minute. So the inability to perform 2 out of the 6 activities of daily living, or ADLs, typically any modern policy does include cognitive impairment like dementia or Alzheimer's. Those would count, even though physically you might be able to do all 6. And one thing I didn't mention, I meant to mention back on the discussion about traditional and then the hybrid or single pay. Traditional is potentially income tax deductible. With the single pay, you can't deduct that full single premium from your income taxes. So again, pros and cons to each, and we'd be happy to go over those one-on-one with you. And sometimes a combination does make sense. So there's a daily, weekly, or monthly benefit amount, and then there's a cap. Usually it's a number of years. So to pay that much per day, say $150 a day, up to $150 a day for 3 years. If you're using half of that a day, it'd be 6 years, or any combination until you've used up that full pool of money. With some of the policies in the past, it was a use it or lose it scenario. And then with other policies in the past, it was an indemnity policy to where, and you don't see these much anymore, once you qualified, they were going to pay you $150 a day, even if you're only in need of $50 a day. You don't see those very much anymore because they're very costly for the insurance company. It actually put them at a lot of risk. So the elimination period is the time between the illness occurs and when the benefits begin. It's real similar to a deductible. It's usually measured in days rather than dollars. And you just self-insure during that period of time. In general, obviously, the shorter the elimination period, the higher the premium. Just like with insurance, the lower your deductible, the higher the premium. The higher your deductible, the lower the premium. Kind of works the same way here, but now we're talking about a period of time. So here's some of the exclusions. For example, they usually will exclude alcoholism. If you need to go into a facility or receive care at home due to alcoholism or drug addiction, most long-term care policies are going to exclude and not pay in that instance. There's also, if you've got coverage paid for by the government, you can't basically get coverage from two places, is what they're trying to say there. And then there's some policies have a waiver of premium, meaning once you get into benefit status, they're not going to be writing you checks and expecting you to write checks back to them at the same time. They don't all work that way, but most of them do today. There's care advisory services. There's bed reservation benefits. The bed reservation benefit is, let's say you're in a nursing home and then you need to go to the hospital for a period of time, then back to the nursing home. Some policies will continue to pay that nursing home for up to 30 or 60 days to keep that same bed to make sure you get to go back to the same facility. There's respite care benefits, which can help pay cash to an individual that's been taking care of you like a family member if they need a break for a period of time. And some policies, by the way, do allow for a family member who's not licensed to care for you. Some do, some don't. That's another kind of some of the pros and cons of different policies out there. And then as I mentioned earlier, a real common benefit today is a shared care benefit where you can borrow from your spouse's policy if you use up all your benefits. It allows you to actually get a shorter benefit period but still be protected for a longer period of time in a worst-case scenario. Now, your total protection for both of you obviously wouldn't be as big, but it is a way to keep those premiums a little bit lower, and I think it's a really neat concept that they've come out with here in the last couple of years. So what if you don't end up needing care? Well, with a traditional policy, it's a use it or lose it, which is how all insurance works. But the premiums, if you look at the amount of money at risk from the insurance company, especially if you have an inflation rider and you look out over time, you purchase a policy in your 60s and you look at the potential outlay from the insurance company when you're in your 80s, and maybe they are on the hook for $400,000, $500,000, $600,000 or more. Now all of a sudden that $2,000, $3,000, $4,000 a year premium doesn't look quite as high when you compare it to the potential cost that you're protecting against. Fewer insurers are providing long-term care insurance. A lot of companies have dropped out of the industry in the last couple of years, and I know some of you are either employees or retirees of AT&T or Lockheed Martin, both of which John Hancock dropped out of the group long-term care insurance market and no longer provide coverage for those employers. And we've seen on the individual side, a lot of companies have dropped out. Prudential, among others, have dropped out, and there's still big insurers. The three that we most often quote are Genworth, Mutual of Omaha, and Transamerica, all three really, really big companies, all of which have been in the long-term care business for a really long time and have really strong policies. So in most cases, we try to quote from all the companies out there. Most often it narrows down to those three. Sometimes it's two of those three, depending on your circumstances. And then the company that we actually work with, the agency we work with to run those quotes, they narrow it down to the best three, and then the best one of the three, and they tell us why they think that's the best of the three. And so it's nice that we can shop and compare, and it just depends on if you're married, the difference in your ages, if there's health history, family history. Sometimes one company is better in your case, and a completely different insurance company might be better in somebody else's case. It's always interesting to see the why behind which company ends up being better for a particular individual or a couple who's looking at protection. So the benefits are paid. It's typically reimbursement of the actual cost that you incurred up to that daily benefit amount. The older ones, the indemnity, like I was talking about, they pay an amount regardless of the cost. So you could actually be cashing in and making more money than the costs are. Most companies have gotten away from that because, again, it can be real costly for the company. So traditional long-term care insurance provides coverage of qualified long-term care services, and it's guaranteed renewable, so they can't just drop you because they feel like it. They can't just raise your premiums because you had a hospital stay. They can only raise premiums across the whole class. It does not provide, and this is a legal requirement, it can't provide a cash surrender value, or you can't use that policy to pledge for a loan, at the bank or something like that. Those are legal requirements that cannot occur. And then qualified long-term care services are defined as necessary diagnostic, preventative, therapeutic, curing, treating, mitigating, and rehabilitative services and maintenance or personal care services that are required by a chronically ill individual, for this is a mouthful, and that are provided pursuant to a plan of care prescribed by a licensed healthcare practitioner. Chronically ill individual would be somebody suffering from a severe cognitive impairment or somebody unable to perform at least 2 of the activities of daily living for at least 90 days, and then certified by a licensed healthcare practitioner within the last 12 months, like I was talking about earlier. So premiums for long-term care, and I haven't checked I meant to check before this webinar to see if these had changed. I think they're still the same, but I mentioned earlier that premiums are potentially income tax deductible for traditional long-term care, which is basically the annual pay, the ongoing pay, monthly, quarterly, annual pay. And it's limited to expenses that exceed 7.5% of just gross income. I do think that's 10% if you're under age 65, 7.5% if you're over 65. That's from memory, so don't hold me to that. But they do limit it to these dollar amounts. These may have gone up a little bit. That's what I didn't get a chance to double check before the webinar. In other words, the IRS has a cap of what you can deduct, even if your premiums might be a little higher than that. So if you're in your 60s, though, it's a pretty big amount. We quote a lot of folks in their 60s that are not paying $3,500 a year each, and this is a $3,500 a year each eligible premium deduction between age 61 and age 70. So they're pretty liberal with the amount they let you deduct, but unfortunately, you can't just deduct it across the board. When they first announced a few years ago that long-term care premiums were going to be deductible, we thought that meant they were, in fact, just going to be straight across the board deductible. No, they're included as a eligible health care expense, which if you're able to deduct your health care expenses, this would add to that. So they're potentially deductible. And in a lot of cases, as you age, they are, but it's just know that they won't automatically always be income tax deductible, depending on your situation. So you can have a lifetime level pay. There's some, this is becoming a little more popular, a limited pay, where maybe you pay for 5 or 10 years and then you're done. Maybe you don't have the money to do a lump sum, but you like the idea of paying for a limited period of time, not forever. And then there's often spousal discounts, even if your spouse is not applying, or for example, sometimes we'll have a case where a couple will apply, one spouse will be approved and the other spouse, for some medical reason, is not approved. You still get a spousal discount, because there's many studies that have proven that if you're married and you have somebody else in the household, you tend to have needs further out in the future and less often than somebody that lives alone. So you still qualify for a spousal discount. Now, they give an additional spousal discount if you both are approved and qualify. It's almost like you get a double discount. But you do, in fact, get a discount just for being married or living with someone, having a significant other, even if they're not applying or not approved, which is, I think it's a nice benefit. Now, the hybrid products, they offer 2 benefits. You've got a life insurance element, like I was talking about earlier with the lady who, $100,000 goes in. That's the one-time single pay. Death benefit of $150,000 immediately, slowly drops down to $100,000 over the years, pays income tax-free to the heirs if she doesn't use the policy for long-term care or doesn't change her mind and take a full withdrawal at any time. But then, of course, there's long-term care coverage of up to X amount per day for so many years that typically initially it's at least 2.5 times the single payment, up to 3 or 4 times the single payment, depending on your age. And then, of course, with an inflation rider attached to it, 10, 20, 30 years down the road, it could be many times your original payment. But it's really designed, the hybrid is designed for flexibility and long-term affordability. It's a little more expensive up front, obviously, but then you don't have to worry about premium increases. You can get your money back at any time, and it pays back to your heirs if you don't use it during your lifetime. It does avoid the use it or lose it problem with standalone, and I'm not putting down the traditional. I think there's still a lot to be said for a traditional policy because it's a fraction of what the single pay would be. It's just you're paying over an ongoing period of years. The provisions are usually very, very similar. when it comes to the daily dollar amount and the pool of money and those kind of things. They work very similar when it comes to that. It's just a difference of how you're paying for them. You know, this is I wanted to throw this in there, and I forgot I had this slide. It's the example of an actual client that I was referring to earlier, and I forgot I had the numbers in here. So it's a $100,000 one-time payment, fully refundable at any time. An immediate, I think I said 360 earlier, immediate $382,000 long-term care benefit payable at $5,000 a month until that 382 is exhausted. But that's the initial amount. Every year that grows because it's got an inflation rider. So by the time she's age 80, and the death benefit, I was thinking it was 150. The death benefit's 118, immediately paid. If somebody was younger, that death benefit would be a little higher. If somebody was older than 62, it'd be closer to the initial premium. But by age 80, it's $596,000 of long-term care benefits payable at $8,000 a month, or $118,000 death benefit if she doesn't use it during her lifetime, or a full refund of the $100,000 anytime she changes her mind, which is not likely the case, but in a big emergency or something, you can always get your full premium back at any time. So I think they both have some advantages and disadvantages, but it's definitely worth considering. Oh, and by the way, you can't use IRA money. You could cash out an IRA and pay all the tax, but you definitely would not want to do that. This is for non-qualified funds, non-401k, non-IRA money. I'd call it lazy money. If you have lazy money sitting in the bank earning next to nothing, and you could do this and still have emergency funds remaining in the bank, this might not be a bad strategy, or even a combination of traditional and hybrid like I talked about earlier. So there's traditional and hybrid. They both can include inflation protection. If you're under age 70, I think you definitely need inflation protection. But with that being said, I'd rather you see you get a base policy without inflation protection than not be protected at all. But you definitely need to consider inflation protection if you're under 70. And even into your 70s, I think it's something that should be considered. And then shared care and or spousal discounts are very typical in both types of policies. So in summary, retirement income planning really should include the potential cost of health care and long-term care costs. These costs, they might be known. You know what your Medicare premiums are. You know they might go up a little bit every year. But the unknown cost for reimbursed care, that's a huge question mark. And long-term care is probably the best way to help protect against those future unknown costs. So definitely, if you want to talk about this one-on-one, we want to have us run quotes for you. I want you to remember this. We can adjust a policy to have all the bells and whistles, and we could probably make it quite expensive if you wanted to throw everything on there and have, for example, a lifetime policy. But we could also run a very bare bones policy, maybe with no inflation rider at maybe 100 or 150 a day, no inflation, maybe a 2-year benefit period. It's certainly better than having nothing at all. Most of our clients end up wanting something between those two extremes. But what I like about individual coverage, which is quite different from group coverage, like I said earlier, that's what you see is what you get. With individual coverage, think of it like a pizza. You can get a cheese pizza, or you can get a meat lover's pizza with all the veggies on it too, or you can get anything in between. And we can remove or add ingredients to suit your desires and your budget. So we're excited to help you in this regard. We used to refer this out to long-term care specialists, but we just got tired of the lack of communication between us and the outside party, maybe lack of follow-up. And so we've been pretty well-versed in long-term care for a number of years, so we decided to bring it back in-house here in the last year. And it's really been interesting working with clients directly in this area. So we're happy to run quotes for you, talk to you about it, pros and cons, and assist you in any way we can. If you want to give us a call and talk about it, our numbers are on the screen, or shoot us an email, and we'll talk about it further. Meredith, do you have anything? All right, thank you. I hope everybody enjoyed today's call, and we will talk to you soon. Have a great weekend, everyone.